Rockets and Knicks were in Game 5 when O.J. started that fateful drive. His four-way hazard lights were blinking, and no one knew what the Jews was thinking.
I've been to Reno, Chicago, Fargo, Minnesota, Buffalo, Toronto, Winslow, Sarasota, Wichita, Tulsa, Ottawa, Oklahoma, Tampa, Panama, Mattawa, La Paloma, Bangor, Baltimore, Salvador, Amarillo, Tocopilla, Barranquilla, and Padilla. I'm a killer. I've been everywhere, man. I've been everywhere, man. Across the desert bare, man. I breathe the mountain air, man. I've traveled, I've had my share, man. I've been everywhere.
This is Oversight Live, your advocate for good governance. We're putting the site back in. Oversight. Here's the watcher on the wall, your host, Ben Carpenter.
Good evening, everyone. Welcome to Oversight Live. This Wednesday, 25th of March, 2026. Thanks for joining us. Man, I had dinner and something went down the wrong tube, and I'm going to be struggling here this evening. But that's what life is all about. Look, Oversight Live. We exist because it is hard to get to Juneau. Expensive, both time and money. Got to take a ferry, got to fly, got to get a hotel, got to eat out for a couple meals at least. It's expensive. Hard to provide oversight of your government when it's so far away. But technology being what it is, we get to watch what's happening down in Juneau, but sometimes it's just kind of confusing and we're not sure what's going on. So with my 6 years in the legislature, I am going to bring you relevant content online and help explain it and share my experience. And you can provide me with questions if I'm not covering what needs to be covered, or you just have questions. Chat them in the window there on your social media app. We should be broadcasting live on Facebook. I just got message that we are, so that's good. If you want to check us out, drop us a note there. Click the like, click the share, get us going if this is of value. So tonight we're going to dive into a couple things, and it's going to be in the financial arena. Kind of taking a hiatus of that for a couple of episodes here, but now we're going to talk about House Bill 289, which is the second budget, or also known as the supplemental budget, that passed the legislature today. And we'll take a look at what the conference committee did and what is headed to the governor. And then Senate Finance today had a couple bills up in a presentation by Callan and Associates. One of the bills' presentation was by Callan and Associates, and we're going to take a look at that today, because I think of all the issues facing the legislature this year, this bill that they talked about and what Callan presented on is probably the thing that has the greatest potential impact to the state of Alaska moving forward. And of course, we're talking about permanent fund, changes to the permanent fund and to the structure of the earnings reserve account and to the percent of market value draw. Okay. So those are things that are going to have long-term impacts to both the state budget and to Alaskans and to our economy. So we're going to listen to what Callan had to say about the analysis that they've done. And I've got some thoughts that I want to share with that. So let's jump straight into the what happened in the legislature, I guess I should say, because both the Senate and the House Okay, so that's a little bit bigger, but let's make it big enough for you to see for right now. Okay. So if you're wanting to know what's going on with a bill, this is the supplemental budget, House Bill 289. You just go up to this link up here and search for your bill. Just type it in, and then it will pop up. So you know you've got the right bill when the bill number says the number you're looking for, or it's got the title that you're looking for. This is the longer title. All right, so let's get to it. Everything that happens on the floor and also within committees is kept within the journal of the legislature. So this actions tab right here tells you what has happened on what date within the journal. It's official action on this bill. Okay. So you can see that it was first introduced and first read across the floor in the House, because there's an H here, on the 4th of February of this year. Okay. All the way down at the bottom, a lot of action that's happened. March 25th today, the House finished what it needed to do, and the bill is now awaiting transmittal to the governor. So that tells you that the legislature is done with the bill and it's moving forward. So now we can back it up to find out what happened today. You can back up to the first entry on the 25th here. Okay. So you could go and watch the video of the session and follow along with the video and take the time to watch what happened today on the floor. Or you can come to the journal entries for that bill and find out what happened on that bill. So to find out exactly what happened in the journal, you click on this number right here. It's a journal entry number. I think that's what they call it here. Let me screw back up. Yeah, journal page. So it's a page on the journal. And that'll give you text of what happened in the legislature regarding that bill. So it says here, the following report was received. And this report says the conference committee with limited powers of free conference considered the Senate committee substitute for House Bill 289 Finance, amended Senate and committee substitute for House Bill 289 Finance, budget reserve fund, majority failed. I am not sure what the sup means. Maybe that's supplemental, but I'm not sure. Anyway, but that's a failed. So that's the 3/4 vote that was necessary for the funding structure in the House's version of that bill. So it recommends the conference committee substitute for House Bill 289. So now they've created, the conference committee created its own committee substitute and submitted it to the bodies for ratification. Okay. So then it says all of them. I'm just counting here. Chair, 1, 2, 3, 4. Yeah. So all of them recommended that it go forward. In the Senate, that committee substitute passed in a 19-1 vote. Okay. So all of the yays listed here, Senator Myers voted against it. Okay. So then what happened today? Adopt the budget reserve fund. So there's still a vote that they took with regard to the budget reserve fund in the Senate. 16 yay affirmative and 4 nay. Okay, so Senators Kaufman, Myers, Rauscher, and Tilton all voted against the funding structure that is in the bill, and we'll cover this in just a second of what's left in the bill with regard to drawing from the savings account, our budget reserve fund. So in the Senate, it says here, the Constitutional Budget Reserve Fund section was adopted. But as we'll see when we get to the House, it's clear that the House version, the House vote was not the same. Okay, so that's what happened in the Senate. Click back, and now we can come, still looking for today, we come down to the House. So that was all, this is all Senate action. And they adopted the committee substitute, committee report here, 19-1. All right, so the House took it up. Oh, let's see here. Where's the vote? Okay, so here is the adoption of the report, and it is a 40 yeas to 0 nays. So nobody voted against adopting the report. The Constitutional Budget Reserve Appropriations vote was 22 to 18. Okay, here is everybody that voted no, which is the significant part. And so lacking the required 30 votes combined between, that's 30 votes in the House, the appropriations from the Constitutional Budget Reserve Fund were not adopted, and the new title follows. Okay, so the original title of the of the bill here, notice this, the original title, it included, says, making appropriations under Article 9, Section 17C, Constitution of the State of Alaska from the Constitutional Budget Reserve Fund. Okay, so that portion of the title and that portion in the bill didn't make it through the House. It made it through the Senate, but it didn't make it through the House. So that vote then carries forward with a new title, and that section is removed. Okay? So let's go back. And now I want to show you what happened, because this is significant. You probably didn't know. Okay. So I just clicked on the full text so that we can read this. Okay. So here, look here. The date is from today, 3/25 and 3/25 in the House from the Senate. That version passed the Senate, but it didn't pass the House. Okay, so what version is this? Let's click on this. Okay, this is going to take us to the bill. And I've already had it preloaded here to take us to the appropriate page. Let me blow this up just a minute so you can see what it's saying. Yeah, and I don't have the LNG presentation loaded up from House Resources, but yeah, I need to show that one. Maybe we'll hit that tomorrow. Okay, so in the version that passed the Senate, there's a Constitutional Budget Reserve section here in section 21. Okay. Let me scroll up real quick and I will show you another thing that changed here that is different. Okay. Where is it here? Okay. Section 16, fund transfer, an amount equal to the amount appropriated in the Alaska Higher Education Fund in last year's budget. $129 million is appropriated from the general fund to the Alaska Higher Education Investment Fund. So if you remember from a previous meeting, I told you that's likely what they will do. It used to say from the Constitutional Budget Reserve instead of the general fund. But because members of the legislature, the Republican minority, said we're not transferring money from one savings account to another. If you want to plus up your education fund after you rated it, then you're going to do it from the general fund. That means you have to find other dollars to spend on other programs. Okay. So now they just took that out, and by passing the bill, the higher education fund will have an amount from the general fund. And this is basically coming from that excess of oil money that we're getting now because of the Iran war. There's room for them to be able to transfer $129 million of that money to the higher education investment fund that got rated in the current year's budget. Okay. Back in May of last year. All right. So now we go back down to the bottom of the bill here where the CBR language is still in. And what is it? Why did they have CBR language in here still? If they were wanting to spend from the general fund instead of the CBR in that other section. Okay. Well, look at this. This says if the unrestricted state revenues, that's the general fund, and the funds that are in the general fund, simple majority vote. If the unrestricted revenue available for appropriation in fiscal year 26, which is current year that ends in June this year, is less than the general fund appropriations that take effect in fiscal year 26 that are made in this act. Okay. So if the available revenue doesn't match the available spending that we authorized as passed by this legislature in the second session, and then talking about and the general fund appropriations that take place. And this is referring to Chapter 10, SLA 25. I could stand corrected, but I think what this is this is the leftover provisions from the previous fiscal year, 2025, fiscal year 25 budget. Because this is actually talking about fiscal year 26, but they're also referencing what's left over from fiscal year 2025. Okay. Basically what they're saying is if the appropriations that we made this year, the spending that we want to do, we don't have enough revenue for that, then the money is appropriated to the general fund from the budget reserve. Okay. So this is what you call a blank check. This is a blank check. It says, if there's anything that we wanted to spend money on and we didn't have enough money for it, well, then the legislature is just going to authorize it to come out of the constitutional budget reserve as the savings account. Blank check, including previous fiscal year spending. Okay. Also, Section B, so that was Section A of the CBR language. Section B says if appropriations made in A of this section, the unrestricted state revenue for appropriations for fiscal year 26 is insufficient to cover the general fund appropriations that may take effect, the amount necessary to balance revenue and the appropriations. But this is only for fiscal year 26. It doesn't include fiscal year 25. See, that's missing. So this is talking specifically about fiscal year 25 and 26 spending. This is specifically just about 26. If we don't have enough money in our current budget, then $20 million is the cap. It's the total amount that we'll allow ourselves to spend from the CBR and appropriate to the general fund from the CBR. Okay, so that's a long way to say that the Senate agreed to give our state government access to the savings account for the previous fiscal year and $20 million for this fiscal year, current fiscal year, if we don't have enough money in the general fund to pay for our spending that we appropriated. So a supplemental budget, that's coming in, asking for more spending. And then in the supplemental budget, there's headroom. There's a mechanism to allow you to spend $20 million more. And we don't even know what it's going to be for. Just if you're short, you got $20 million. All right. Let me back up. All right. The bill that passed the House is this bill, this version. So you can see over here, this is version F right there. This is version G. So when we go into version G and you scroll all the way to the bottom, there's no CBR language. Okay. So what happened, here's the fund transfer. Higher education fund is coming from the general fund, right? Whoops, I'm goofing my screen up here. Coming from the general fund to the Alaska Higher Education Fund still, but there's no CBR language. There's no authorizing ourselves to spend money from the CBR, okay? Because it failed in the House. So this is the version. Version G is the version that moves forward. Okay, so this version right here is the version that moves forward, and it's waiting transmittal to the government. Okay, so with your Republican minority, what they were able to do with these crazy people in the legislature was prevent the legislature from giving the government a blank check for fiscal year 25 leftover spending and a $20 million check to spend in excess of the supplemental budget and the first budget. So in excess of budget number 1 and budget number 2, the minority said, no, we're not going to do that. They were able to hold their ground and prevent that additional spending from happening. Okay. So I think they deserve a thank you, in my opinion, for for taking that stand. All right. Yeah, Brian, max headroom. Yeah, as I read it there for fiscal year 26, $20 million would have been the headroom to spend from the CBR, but that's no longer, it's not an issue. That provision did not carry forward, and it's not going to the governor for signature. So pretty sure he's going to sign this supplemental, and we'll be a little over $1 billion more in appropriation here. I can see myself on my little screen, but you can't see me. There'll be a little bit more than $1 billion appropriated in this budget when you include federal dollars and state dollars. So big supplemental. Okay. I'm looking here for questions. No questions. All right. If you got questions, if you think of them, just holler and we can come back to it. I want to move to the Senate Finance Committee, which means I got to share a different screen here. And this is not a significantly long briefing, but it's long enough here. Okay, let's go to this. Yeah, I'm sharing that screen. So let's make this bigger for you to see. Bang, there it is. All right. So this is Senate Finance. This is Senator Hoffman as the chair, and he's introducing the representative from Callan to talk us through what the Senate proposes to do with the 5% market value draw and reducing it to 4.5% over a number of years. Callan's going to come in with some analysis on what that means to the state. And there's some really key takeaways here that I don't think that they touch on that we need to be aware of. Okay. So
we'll hear a presentation on the perm fund draw analysis from Callan. Callan is on the line. Callan, please identify yourself for the record. We have someone to flip the slides for you. So when you're ready to go to the next slide, please say, switch slides. You have the floor.
Thank you. For the record, this is Greg Allen, CEO and Chief Research Officer at Callan, the longtime consultant to the Alaska Permanent Fund. And I'm here to make a brief presentation on some work that I've done looking at SB 274 and its implications for the draw and for the permanent fund and so forth.
Okay, so first off, just to be clear, Callan in this instance is not working for the legislature. It's not working for the Senate Finance. It's working for the Permanent Fund Corporation. So the presentation that they're going to present is going to be an analysis on the bill that's before them, before the Senate committee. But this is an analysis from the contractor that's hired by the Permanent Fund Corporation to address this issue. So if it comes out, weighing on one side or the other of the bill, then you know that that's the direction that the Permanent Fund Corporation is looking to go. Okay. That's another way to say that's the Permanent Fund Corporation lobbying the legislature on how it thinks the legislature should act.
So if we can just go to the very first slide, which is actually slide 2, which is the outline. I'm going to give a little bit of a perspective on the historical results, how this would have behaved in the past. I'm then going to talk a little bit about the mechanics of 274, just so everybody's clear on what I've done. And then I have a model that looks out about 20 years to see the impact. And it's a pretty simple model, but it does take into account all the mechanics of the permanent fund. But I'm focusing on sort of the median or the middle outcome as opposed to looking at the worst case outcomes. So that's the plan. And, of course, I plenty of time for questions, but if you have questions in the middle, please interrupt me.
That may be the extent to the acknowledgement from Callan or from anybody else here that this projection that they're going to show, the 20-year projection, is a he says median, but at average or median projection, it is this is what happens if things go the way that we want them to go, and it's middle of the road, not the extremes of what happens if we have high prices of oil or high inflation or low returns. None of that's not being factored in. It's just if it continues on the way that we think that we want it to continue on, with consistent returns, consistent inflation, no bumps, no nothing goes wrong. It just goes how we want it to go, how we're projecting it. That's what these numbers are going to represent. Okay. Which means that it's not real. Like, this isn't how it's actually going to play out in the future. If you wanted to see a presentation where you could see the possibilities of the extremes, then you would want a Monte Carlo analysis that would show you what the worst of the worst on the bottom side of the opportunity and the worst of the worst or best of the best on the upside of the opportunity. What are the ranges of possibilities? But we're not going to see that. He said he's going to show a simple analysis, and we need to keep that in mind as you're looking at this, that just because there's dollar figures here, it doesn't mean that's what's actually going to happen. It just means that's what we would like to have happen.
All right. So if I could advance to the next slide, which is slide number 3 and the page number on the bottom right. This is an exhibit that I showed at the last time I was up there. And what this exhibit shows you, the orange line is, going back from the beginning of 2000, this is the CPI plus 5. This is what you would this is what it would look like if you earned CPI plus 5, every single quarter since 2000. The blue line is the permanent fund's actual net of fee return over that same period. And if you'll recall, I was just pointing out the fact that because you have to take risk to earn CPI plus 5 over the long run, you can have periods where you're behind and periods where you're ahead. In this particular case, I chose this time period because it started off poorly. And so when time periods start off poorly, you get behind, and it often takes a long time to catch up. And my final point is that over this 25-year period, the permanent fund is actually behind CPI plus 5.
Okay, I want to highlight something here really quickly, and then we'll continue on. CPI plus 5 is the target. That's inflation plus 5%. That's the target goal Permanent Fund Corporation sets for their investment earnings. Okay, CPI is 2.5%, is kind of what we think it's going to be averaged over the long term. So you're really looking at 7.5% is your target earning of the fund, the big fund, the whole thing. What this chart is showing you, I don't mean to insult your intelligence, but it's saying here in gold that the target of the Permanent Fund Corporation from 2000 to 2025, the target we didn't reach. The blue is what we did. The gold is what we wanted to do, CPI plus 5. Okay. So we didn't reach our goal most of the years. Right now, if the action of the legislature as proposed to roll the earnings reserve account into the corpus of the fund and draw from the fund 5% of the market value every year, regardless of whether you met CPI plus 5 or not, every single year where your blue line is below your gold line and you didn't meet your CPI plus 5, you would be spending from the corpus of the fund in order to draw that 5%, because you're not earning what you need to draw CPI 5% draw. Okay. CPI plus 5 is inflation plus 5. So if you draw 5% out, you're drawing a portion of that from the principal of the fund. as it stands right now, if you're having to pull from the earnings reserve account in a year where you don't earn CPI plus 5, you're pulling from your earnings that you've saved within your earnings reserve account. And if you have too many of those years, your earnings reserve account might get down to nothing. If you're not making enough money on your investments and you're spending 5%, then you might spend down your earnings reserve account. You get to a point where you can't spend anymore. There isn't enough money to pull a 5% draw. And we'll talk about that here in a minute. But I just want you to highlight why the legislature thinks it now needs to move from a 5% draw to a 4.5% draw. If the permanent fund corporation keeps the CPI plus 5 as its target, but we only draw 4.5%, then that blue line and that gold line, I'm sorry, those aren't going to move. That's the fund's performance. You just don't draw from, you don't overdraw the fund unless you're below this, unless 4.5% is below this blue line, whatever the actual return is. Okay. So it's still possible with a 4.5% draw to not earn enough and still have to spend from the corpus in any given year from the principal of the fund. But 4.5% is more conservative than 5%. Okay. He'll get into this, and probably another slide will make more sense out of it.
Okay. So, and there are many other periods where it's ahead of CPI plus 5. In fact, if you just go back to start this thing in 1995, which I showed, it's actually ahead. So it's very time period specific, but I like this time period because of what it shows on the next page. So if we can go to the next slide. The only thing that I've changed between these two slides is now the orange line represents CPI plus 4.5%. So you can see that miraculously, the permanent fund hits that number almost exactly at the end of 2025 and stayed much closer to it in spite of the .com and the global financial crisis and COVID, et cetera. So this just illustrates that even though it's a 0.5% difference in the target, over the long run with compounding, it makes a pretty big difference in the outcome. And so the permanent fund over this 25-year period would have met that CPI plus 4.5%, which of course is the draw rate that's being contemplated at the end of the introduction period for SB 274.
So a question for this slide would be, does this take into account what your spend would have been in those years if you were using a 5% market value draw and you didn't have enough earnings to pay for it? What happens with that value of your fund if you don't have enough earnings and you're still drawing 5% or even 4.5%? Okay, that is not being discussed here yet.
I'll stop, and if there are any questions, please ask.
Any questions from Senate Finance Committee members? Seeing none, Mr. Allen, please proceed.
All right. If we can go to the next slide. I'm just giving you a little bit longer perspective on CPI, on earning 5% real, CPI plus 5. So in this chart, the blue line, we don't have returns going back to 1926 for all of the asset classes that the permanent fund uses. So I'm using a 70-30 stock bond portfolio as a proxy for the permanent fund's kind of current risk posture, which is about right. And so I'm showing the blue line is the trailing 10-year return for that 70-30 mix, and the orange line is the 5% real. So I'm just giving you a perspective of how many, what percentage of the time, if you look back 10 years over the last 100 years, would you have been ahead of 5% real? And you can see about 65%, 64% of the time you'd be ahead, and about 36% of the time you'd be behind. So that's the very, very long-term perspective. So you can't invest in anything where you're always going to be ahead. There are going to be periods where you're behind and periods where you're ahead, and that's just the way investments work. So the next slide, all I do on slide 6 there is the orange line just drops by 0.5%, so I'm showing 4.5%, but the percentage of times that you're ahead now bumps up from 64 to 71. So again, 4.5 is an easier target to beat than 5. I went through a lot of trouble to show that very simple concept. But it does matter, kind of given the risk profile of the permanent fund and what's reasonable in terms of what the expectation that they can earn over long periods of time.
Okay, so again, if your returns were 4.5% instead of 5% plus CPI, it's real return because they're accounting for inflation. If that's what this is, and again, this is only over the long term, you're assuming the average is out to be 2.5% inflation. If you have periods of higher inflation, then this doesn't work anymore. Okay, the numbers, the chart would look different. And the blue line is showing you that some of the time you're earning more, and some of the time you're earning less. And this is the key. This is the point that I'm trying to make over and over here. The times when you're making less and your inflation goes up, if it does, or if you just make significantly less, you're going to have to spend out of the principal potentially in order to pay that annual draw. Okay. So you think that you're going to make that up in the future. But if you do too many years of that, then this has to be significant in order to pay that back and pay back what would be the effect of compounding interest into the future. Okay. Well, let's find out whether anybody's asking questions about that concept. All right.
All right. The next slide is simply a review of something I did the last time. I just want to mention this. This is me going back in time to the beginning of 2000 and assuming that you had a 5% draw the whole time, and invoking the ERA limit. So these are actual returns for the permanent fund, actual statutory net income, and then we've overlaid this new 5% draw, which is what we're operating with right now, where it's 5% of the first 5 years of the last 6 years. So I just,
So the 5% is represented by the gold. What's available in your ERA is blue.
Went through this just to show that there were some periods, for example, in 2009, where the earnings reserve account, the 2-account system, would have come into play, and you would not have been able to make the 5% draw in 2009 and even into 2010. And there's some other periods in here where it kicks in and you're not able to make the full draw.
Okay, so what's happening here is your earnings in your earnings reserve account are dwindling in 2008, 2007, 2006, 2005, or some combination of years prior to 2009. For whatever reason, whether it's bad investments or investments that didn't provide the returns that you were expecting versus the money that you were drawing from it, right? So what were we doing in 2007, 2008, 2009 with the permanent fund earnings? They weren't funding government. We didn't start that until 2016. This is all permanent fund dividend time frame. Okay, where the only thing we were doing with permanent fund earnings is paying a dividend and inflation proofing, because that's what the statute authorized the legislature to do with it. Okay, so what this is saying is in those years where you have hardly any earnings reserve account money in the system, in the account, you don't have any money there, you won't be able to draw from the earnings reserve account because it's not there. If you combine the earnings reserve account into the corpus and you constitutionally allow the draw to happen, regardless of whether you have the returns to support it, then in those years where you see blue below the orange, those are likely years. If you're extrapolating this into the future, the example is these are years where you would be drawing from the principal likely in order to pay your draw, because you don't have enough money in your returns to do it, to pay it. Okay. Again, is that something that that train of thought or those questions being asked?
So And then just to review, on the next slide, this is what I showed, same thing I showed last time. All I've done here is overlay the 4.5% draw. So even with this reduced draw in 2009 and in 2010, and a little bit in 2013, you would have fallen short of what the 4.5% formula would have required. So, and that's just, again, the ERA kicking in. Importantly, I think we started this period with a very low balance in the ERA. And like I said, 2001, 2002 were not great investment years. So, you know, in some senses, this is probably a worst case scenario. Right now, we got a very healthy ERA. If we started this with a big giant ERA, you know, you might have been able to survive 2009. I'm not sure.
So you've got the formula is a percentage of the previous 5 of the last 6 years. So what he's saying is 2002, 2003 investment years, it isn't reflected here, but he said they were poor investment years. Okay. And then, so if the poor investment year is ending in 2003 and 2004 was a positive investment year, that's one. I guess you could count 2003 as 1, 2, 3, 4, 5, 6. And that's what your 2009 would be using 5 of the last 6 as an average. So whatever happened here in your low returns is going to affect your fund or your fund balance, and then your averaging is impacted by that. So, and I might get might be getting my wires crossed here, but I think that's what he's referring to, is because you had 2002 and 2003 bad investment years, it affected your available balance in your earnings reserve account. And then in 2009, you basically would run out of money or not have enough money to pay that 4.5% draw.
But we're definitely in a better, more healthy position with a big balance in the ERA right now than we were back in 2001. All right, so that's the history. Now what I've done, I want to talk a little bit about the draw mechanics of 274. As I understand it, I read the bill. So the idea is that starting in 2029, so 26, 27, and 28, the bill does not do anything to the draw, as I understand it. And then beginning in 29, the draw starts to ratchet down at 0.1% a year until it gets down to 4.5% in 2033. So I think what's important to note is the formula takes the 5-year average and, you know, it looks back 6 years. So my point for showing this slide is that it takes a long time for the effect of this bill to fully impact the permanent fund draw model. Because first of all, you got to get all the way to 4.5%, and that takes until 2033. And that's the first year that the lower draw takes a full effect on the market value. So when you reduce the draw, the market value is bigger and it can earn more money. But it's not until you get to 2039 where the 4.5% is fully realized. So I just want to make sure everybody understands this is a long-term commitment to a more sustainable draw.
And what that means, what he's saying is 1, 2, 3, 4, 5, 6. That's the first year that you have a total of 6 previous years with a 4.5 draw.
But it is going to take a long time for it to work itself into the system compared to just adopting 4.5% starting tomorrow. And there's some good things about that, but the benefits of the savings that it's going to create over the 5% draw take a fairly long time to be realized. All right, I'll stop. Any questions? Everybody okay with that?
Okay. This is a key assumption that's being made, and you're gonna hear it again. Because we're drawing 4.5% instead of 5%, you're drawing less from the fund. That means whatever the difference is between 4.5% and 5%, that half a percent that doesn't get spent. So it stays in the fund and it gets invested. And so that money that you are leaving in the fund grows the fund through its investing. And it takes a while for that to catch up and grow the fund. Okay. That's in essence what he's saying. Okay. What is also true is that if you are drawing down the fund in a year where you have low returns and you're not beating inflation, then that has the opposite effect of your 0.5% here of growth into the future. That drawing from the principal of the fund then hurts your ability to invest those dollars because they're not there anymore. You just spent them. It would be similar to spending 5% instead of 4.5%. It would be the same thing, right? In a year where you don't have the returns to match your draw. Okay. But we're not going to hear that. That's not going to be part of the presentation.
Any questions on this slide? Mr. Allen, please proceed.
All right. So we'll move to the next slide. And so what I did was I've got a bunch, and I'm sorry about these being tables and they're probably hard to read, but because I'm going out 20 years, they didn't really lend themselves to graphs either. So we're kind of stuck with this, but hopefully you can see these numbers. So all I've done here is, and this is the median, depending on what happens in the markets, these numbers could be different, but this is kind of the middle. The expectation is that you kind of earn about what Callan has projected you're going to earn given the permanent fund's current portfolio, which is about 7.3% per year. And it just looks at the draw under the two formulas. So you can see for the first 3 years, they're effectively the same. They are the same. And then after that, they start to diverge with SB 274 draw being lower than the 5% draw. But importantly, the draw, at least in this median case, doesn't go down. So while you are absorbing a lower draw rate, you aren't actually getting less money than you did the year before. So I think that's a nice feature of this versus if you took the whole 4.5% in 1 year. It would still take a while to work its way in, but you might have years where, at least a year, where the draw actually goes down year over year.
So this is where I was saying in previous conversation that I had with you, that as we reduce the permanent fund draw, the 5% to a 4.9 and to a 4.8, you're actually drawing less out. But if your fund is growing and that 4.9 is a bigger number than 4.9 would have been the previous year, then you actually have more money, even though you drew less of a percentage. What is key here that we need to understand, and this is the bigger picture, that I'm glad we've got this chart now, because this is actual dollars that they're projecting. And these are just magic numbers. I'm going to just call them magic numbers because everything has to be perfect. All of your assumptions that you're making have to be perfect in order for these numbers to line up. So they're not realistic, but they're just something to show what could happen, right? But here's the point that I want to get to. 2026, the 5% draw is 3.7, almost $3.8 billion. Okay. 10 years, 36, we're at $5.2 billion. That's under a 5% draw, $5.2 billion. Okay. We crossed the 5% in 2035 is what they're suggesting here. 4.9 in 2035. Okay. So again, funding your operating budget, because the PFD is gone, long gone. It's long gone. Okay. You're funding your state government $5 billion every year. But here's the thing that I want you to see. Just look at the difference, the change from year to year. Okay. 3.7 to 3.9. How much is that? 3.9 to 4. We're going to see a slide that shows you what those dollar figures are. But what this represents is additional spending every single year from your permanent fund without taxation. Well, without traditional taxation. Okay. So the government is going to be able to have more money every single year. And it even happens with a 4% draw. It's just a little bit smaller until you get later. And this will show you, he'll show you this again in another chart here. So the point that I'm getting at is if you are a limited government conservative and you're saying, I want to avoid taxes, but I do want to have limited government. Tell me how you're going to get limited government when you're funding your government from a pool of money that continues to grow into the future. Regardless of whether they need the money or not, it's going to get spent. 2045, I mean, this is the state, the structure in the state that we're handing over to our kids. 2045, there's $6 billion for their operating budget. Do we have a population that's going to need $6 billion? I mean, I know that the future generations can decide what they want to do with that money if there's excess and they don't know what to do with it. I understand that argument. But we're setting up a system where the majority of this money is going to the operating budget right now. I think that's the greatest risk going forward, is that continues to happen, is that the operating budget and all of the social programs just swallow up all of this money, and we grow the size of our government and the programs to take care of Alaskans. And it has nothing to do with our private economy. Government jobs, this is the growth in government jobs. That's what this represents.
Now, of course, if there's bad markets, you still can have situations where the draw goes down under both formulas. So I don't want to say that this protects you from the draw never going down, but in the expected case, the median case, because this is feathered in over time, you never are expecting to have a year where the draw drops year over year because of the new formula. And you can see that all the way out to 2045, you're still getting a bigger draw out of the 5% draw than you are out of 274. So it does take a long time to catch up. It's going to be somewhere in the 2055 range, but there's going to be a point where you actually are going to have a bigger dollar draw out of the 274A, even though it's a smaller percentage, because you've been saving. The market value gets bigger.
The principle at play here is because you stop drawing 0.5%, and instead you invest that 0.5%. Compounding interest over time means that that money is going to grow, and you're assuming, and what he's pointing out here is that you're assuming that your growth is eventually going to catch up with where you would have been if you hadn't, and exceed where you would have been if you were drawing 5% instead of investing half that 0.5%. Okay. So by 2045, you're still not you still are not making as much as if you had have just kept spending the 5%. That's only $200 million, $400 million or $300 million difference, right? Eventually that number changes because your compounding interest will grow your fund. That's the theory. That's the assumption. Okay.
And that's a nice segue into the next page. Well, first off, all right, this next one's a little bit complicated, but I think it's an important point, and then I'll talk about the market value after that. So this next slide, on slide 11, the columns are the change in the draw every year, okay? So under the 5% draw, and again, this is the expected, the middle, the median case, the draw is expected to go up every year, all right? If you're interested in what happens in 28, I can explain that, but it has to do with the 5-year average and there being one of the years dropped out, and that caused a drop in the average market value. So
fiscal year 2028, count backwards 6 years. We're right in the time frame that we are right now. We had a year where we had negative returns, or we didn't have very good returns. That's why you've got this lack of growth happening in fiscal year 28 or calendar year 28, whatever you want to say here, but no, it is fiscal year. So that's why you have the drop here, is because you had a bad investment year. You didn't earn what you your target or what you thought you were going to earn, or you had a bad year. Okay. So once that factors into the backwards look, average of the last 5 years of, average of the last 5 of the last 6, then that's how that happens. Okay. I'm making an argument that this doesn't reflect that in that year you had to spend from the corpus, assuming that we would actually do that because we have a constitutional amendment that allowed us to do it, right? That's what they're asking us to do. Roll the ERA in and spend from the corpus. So if you're spending from the corpus in a year where you don't have enough earnings, you're drawing down the corpus. So what does that drawdown do? They're not going to assume that in this chart or any of these other charts. They're not going to make that assumption that in the given years, you actually draw down the corpus. And what does that do to your investment earnings in the future? Okay. That's not an assumption that we're making. It doesn't appear anyway.
Nothing to do with, it just has to do with the mechanics and what has happened in the past with the market value of the fund. But what you see with the SB 274 is that, it's projected to go up each year, 29, 30, 31, but by a smaller amount, by roughly a third of what's happening over with the 5% draw. But eventually, when you get to 2036, the SB 274A draw actually goes up each year by more dollars than the 5% draw. And this is because you're starting to realize the benefit of a higher market value. And so you're going to get a faster growth rate in dollars.
Okay. Faster growth rate in dollars. This whole effort that we're doing right now is to protect our draw. And you can see why, because he's saying that at 2036, given all of the assumptions staying cherry and staying the way we want to project them here. And I know that he's not saying that this is actually going to happen. He's realistic in saying this is just the average, the median, and a lot of things could happen, right? But this is what we think we would like to have happen. Okay. What this represents and what he said is by the time you get to 2036, your rate or your pace, the amount of increase starts to increase faster. Okay. So this means $155 million more than last year, and 164 more than the last year, and 172 more than the last year. This is the difference. This is the change. Okay. So this is representing government growth every year. So where do you think that growth is going to go? Is it going to the capital budget? Is it going to savings? Is it going to the operating budget? Those are your choices. The dividend's long gone. The dividend is gone here within a couple of years or this year, maybe. I don't know. Maybe with the high oil prices, it doesn't go away this year. It's going to be gone. And this represents the money that's going to be growing every year for state spending.
Out of the 274 draw, the 4.5% draw, then the 5% draw. So starting in about 36, if you hold on that long, you actually have a little bit more each year in the year before than you would under the 5% draw. You haven't hit the level yet, but you're growing faster. And that's why you get the crossover eventually. All right. Now if we can flip to...
Again, I have to point out, you're growing faster because you're not assuming that in some of those years, you didn't make your 4.5% plus CPI. In those years where you don't make your 4.5% plus CPI, the following somewhere in the next 5 years, you get something that looks like 2028, where you have less to draw. There's less growth because you didn't have, this is projection because it hasn't happened yet. So they're not projecting that any of these years actually look like what happened prior to 2028 and you didn't have good enough investment earnings. We know that's going to happen. Like better than 50% of the time that's going to happen. Their own charts, Callan's own charts will tell you you're only going to get CPI plus your 5% or your target half the time. Maybe at 4.5%, it's 55% of the time. Okay. but somewhere better than 0.5% of the time or thereabouts, you're not going to get that. So this chart is wildly misleading with regard to what reality is actually going to do. Okay. And every year that it ends up looking like this, that's a year that represents where they've spent out of the corpus of the fund, out of the principal of the fund, because they're going to be able to.
Market values, this is where you see the more immediate benefit of the lower draw. The orange, it just shows cells where the 274 is higher than the 5% draw. So this is relatively straightforward. Under 274, you're taking a little bit less out. And so you have more left. So pretty much under any scenario, whether the market goes up, market goes down, if you take less out, you will have more than if you take more out. And so this sort of shows that. And so the projection in the middle of the range is that when you get to 2045, you'll have about $13 billion more in the permanent fund than you would. And of course, you know, you're earning you're drawing 4.5% of that $13 billion. So you can see, you know, why they eventually cross over. I'm sorry.
We're handing our kids, when they're our age, when they're my age, we're handing them a permanent fund that's going to be approaching $200 billion. And that rate of growth continues. You know how he's saying that when you reduce the draw from 5% to 4.5%, it takes a while for that to catch up to the same amount, but the rate increases. Okay. Well, once it continues, it'll continue to increase, right? In perpetuity. Once you, so what I'm trying to get at here, and I'm stumbling on my words, to get from first dollar to $100 billion, it took to 2031. Okay. 98 billion in 2030, 100 billion somewhere between 2030 and 2031. All right. To get to 200 billion is going to take less years than it took to get to your first 100 billion because of the rate of growth, the amount of money that you're investing. Okay. So in our children's lifetime, it's $200 billion. In their kids' lifetime, it's more than that. It is significantly more. It's $400 or $500 billion. Okay. Or more. I haven't seen a chart that puts it out that far. And all of that's speculative because lots of things can happen between now and then. But the point is this investing and structuring our government to fund itself from the permanent fund means you've got hundreds of millions of dollars more every year to spend on state government, and you will eventually have a government that's got $10 billion to spend on good idea fairies in the legislature. That's the future of Alaska.
12.2 billion. I shouldn't have said 13, sorry. Okay. So far, so good. Any questions?
No questions. Please continue.
All right. Okay, so again, this is sort of just accelerating off that last point. This is my last slide. This just shows you the change in market value. It's just another way of looking at it, but you can see that it's growing by an increasing rate under the 4.5% draw because you have more money compounding. And so the market value is projected to increase by $5.5 billion in 2045 year over year under the SB 274. And by only 4.3 billion under the 5% draw. So you can see, I guess, the point of all of this, was just to go through the mechanics to show how it takes a while for this to kick in. It shouldn't be too painful while it is, and that you end up with a more sustainable draw over time. This will help you in good markets. It'll help you in bad markets. It's just like good savings behavior. So that concludes my prepared remarks.
Just so you're aware, this slide, well, sorry, we changed there before I hit pause. this slide here is the change in the market value. The total market value. So you're adding $3.7 billion in 2033 to your total of your permanent fund. And then 2034, you're adding $3.8 billion more the next year. Okay. So this is the change, the growth of the fund. That's what it's projecting. So every year you've got, when you get down to 2045, now you're adding $5.5 billion. We may only be adding $2.5 billion now, but now we're going to go to $5.5 billion. So the rate of growth grows as the size of the fund grows. Okay. So anyway, I think we're about done with this presentation.
So you can see, I guess, the point of all of this, it will help you in good markets. It'll help you in bad. Questions, if there are any.
I have one that seems to be of interest to people in Alaska. Under the current formula of 5% draw, what year do we reach 100 billion in the fund? And under the Senate Bill 274, what year would we reach $100 billion? Do you have those numbers, or if not, maybe you can provide it.
They're on slide 12. And
see, we were paying
between
attention.
2030 and 2031, you will cross 100 billion under both bills, or wait, I'm sorry, under both spending rules. So because it takes time for 274 to kick in, and you're actually spending the same under both models for the first 3 years, you're almost there by then. And because the amount that you spend notches down ever so slightly in each year under 274 instead of all at once, by 2031, again, this is in the median case, if we have a big market correction, or, anything can happen in the capital markets, but assuming you kind of hit the middle of the road, we're projecting somewhere between 2030 and 2031 under both scenarios.
Yeah, anything can happen, including you spend $1 billion out of the corpus because you didn't earn enough to pay your market value, 4% market value, or 4% of POMV, right? You didn't earn enough to pay that, and so you're going to draw it from the corpus. That's what they want to be able to do. Well, that's going to have a negative impact in how much you can earn, the compounding interest going ahead. That's going to impact that. So this is magic numbers. This is magic numbers. Okay. Why would Senator Hoffman ask $100 billion? Why would that matter? Okay. Well, back in 2016, when Walker's in office and we're having a conversation about, well, what are we going to do? We've got this deficit, and now I'm going to have to steal the dividend and fund government with it. Well, they didn't actually fund government. For several years, that the money that wasn't paid in the dividend, it didn't go towards funding government. They didn't start spending out of the earnings reserve account for operating or capital expenses for many years after. They were growing the size of the earnings reserve account to ensure that when they passed their 5% market value draw instead of the statutory formula for PFD, now they're going to draw 5%. They need to have the money in the earnings reserve account in order to draw that 5%. So they couldn't spend all of the money that was in the earnings reserve account that didn't go to dividend because they needed to build that up. That goes back to the first couple slides where you've got the difference between the orange and the blue bars. They needed that earnings reserve account to get built so that they have money to draw for your 5% draw. Now they're saying it would be much better for us to have the entire permanent fund at our disposal to guarantee that we have that 5% draw. Oh, and 5% might be too much because the chart shows us that we're most of the time we're not averaging CPI plus 5%. So we would be, the draw is too much. So now we're going to pull it down to 4.5, and then fewer times is it too much, but it's still too much in many, many cases. So when those cases do arise, you're going to draw from the corpus of the fund, the principal of fund, in order to pay for your draw. Okay. Now, you want to look out 100 years and say, well, we'll be okay because we can make it up in the long run. Okay. Well, now you're stealing from the future generation and assuming that everything's going to be rosy in the future. You're saying that the risk, I need my money more than you need your money in the future. That's what you're saying. It's more important for me to draw now instead of doing without than for you to have this money invested now and have the earnings in the future. Okay. That's what we're saying when you say, oh, but it doesn't matter if we draw from the corpus, we can earn it back. Maybe we can. Maybe the $136 trillion of federal debt and unfunded liabilities that we have, maybe that has an effect on the stock market for a decade. Maybe we have an entire decade where the federal government runs, the Congress runs our federal government off a cliff financially, and we've got an entire decade we have to make up. You're stealing now, and you don't get to earn it back through that decade because all of your investments are your stock market's tanked. The last 100 years of investment experience in the stock market did not have to deal with $137 trillion in spend. I want to make sure I got that number correct. I got to double check really quick here. I don't know whether I can. It's well over $100 trillion if you combine your unfunded liabilities for Medicaid and Social Security and your actual on the books debt that you have. That's going to have an impact in the future. It'll impact the stock market. It'll impact every aspect of our economy. You cannot grow our economy big enough to realistically grow our big enough to solve that problem. So this rosy picture that Callan is presenting and our there's nobody asking questions about this. There's some pertinent questions here. What happens in the down years? Nobody's asking the questions. I hope they do in the future, but they aren't today.
Further questions of Mr. Allen?
Okay, he's going to ask his question.
Senator Keel.
Oh, there we go.
Thank you, Mr. Chairman. Mr. Allen, I don't believe it's in the modeling. Can you help us think through what the likely impact of the earnings reserve limit that you talked about in the early slides can be in the two scenarios, the 5% and the eventual 4.5% draw scenario? Is that something we should be thinking hard about, or does that kind of come out in the wash?
Meaning, do we need to roll the ERA into the corpus?
Thank you. Through the chair, I've done some work. I actually have a model now that simulates volatility, and it goes out 20 years. I didn't have that last time I was there. So I'm able to look at the interaction of this bill going out 20 years with volatility. You know, on balance, the less you spend, so the slightly long answer to your question is it kind of depends on what the legislature appropriates out of the ERA between now and the future, right? So right now we've got a healthy balance in the ERA, and we've also got a fair amount of unrealized gains sitting in the portfolio. And so when you, just through time, if you have unrealized gains, they get realized and that gets added to the ERA as well. So you're in a really healthy situation right now. And so
I like, my head wants to explode right now. The only way that there's risk of the ERA and being able to spend either a 5% draw or 4% is if the legislature spends from the ERA. What about the unrealized gains? What happens if you don't realize those gains because investments dry up? there's some sort of hiccup in investments in world economy, and you don't get to realize those gains, that disappears. That value in your fund disappears overnight. It's not just the legislature. It's the system that like you think that because you're investing and we've had success in the past, that we are guaranteed to have success in the future. And whatever our investment is now, it's going to continue in the future. That's not a guarantee. Both of those things are true. You could have your unrealized gains dry up in a heartbeat, and the legislature could say, hey, well, we need to spend more from the earnings reserve account. Both of those are true.
When I run the model out 20 years, neither of these spending rules run into problems with the ERA frequently. It's like a 10% probability. The probability is a little lower with the 4.5% draw because you're spending less, but the big variable is how much you move out. So if you keep the ERA fully stocked up, right? If you never appropriated another dollar of inflation proofing into principal, you won't hit the ERA. The ERA is like irrelevant. It's going to get too big, right? But of course, that's the problem with that model, is that it's also technically available to spend the entire thing. And I know that's been a fear of at least certain people in Alaska, is if you leave it in there, at some point you'll get a legislature that just decides to spend it all. So it's an interesting dynamic, because if you want to sustain the draw, you want to keep as much money in the ERA as possible, as long as you have a 2-account system. And again, I mentioned this in the last meeting, but to me, preserving principal is about having a sustainable draw. And so if you can take the idea off the table of just spending the entire ERA, just take that out of the legislature's hands, and you just replace that with a sustainable draw, and you probably have to do that constitutionally. That protects the principal. That's your best shot at protecting principal. Your second best shot is to take all the money out of the ERA every chance you get, but that has the collateral damage effect that when the markets go down, you may not be able to make a draw at all.
Bingo. I'm so glad you said that. Bingo. That's exactly right. And so what the legislature is going to do is it's going to authorize itself to spend from the principal of the fund when that happens. He's not going to say it, and none of those people at the table are going to admit it. But that's exactly what they're going to do. What's good for the goose is good for the gander, right? If this is going to impact the earnings reserve account, and someday you may not have enough money to draw your 4.5% or your 5%, whichever you choose, because of market conditions and things that happen. Well, the same is true if you roll the ERA into the corpus. Your earnings aren't going to be enough. So then what do you do if you've got a constitutionally required or allowed draw? You see the legislature saying, oh, you know what? We can't draw 4.5% or 5% this year because we only earned 2%. So we're only going to draw 2% out. Do you think that the legislature is going to do that? They're going to take a pay cut? They're going to cut spending, or they're going to spend out of the CBR, or they're going to do something else, or institute taxes immediately? No, they're authorized to spend it out of the corpus. This whole thing is to protect the spend. If protecting the corpus is really the goal of Callan and really the goal of the permanent fund, then you would limit your draw when you have years of high inflation and low returns. You would limit it. 4.5% may be way too much. So you would put in the Constitution that says you can draw 4.5% or 5% or 7%. You can draw whatever you want, as long as your earnings over the time period you're measuring, like your 5 of the last 6 years, as long as that average is more than what your draw is. The problem, as they showed on their own slides, is that 5% plus inflation, we're not meeting that. We haven't met it but a couple times over the last decade. Longer time horizon, yeah, we met it more often. But over the last decade, you didn't. So in those cases when you didn't meet it, you would be drawing from the corpus of the fund. If you roll the ERA in, give us the authority that they want to give with this constitutional amendment that they've got in their back pocket. That's 100% what this is. It's protecting the government spend, and they're going to protect it by spending from the corpus. That's exactly what it is. I don't know. Let's see what else is going to be said here.
So I'll stop there, but I think that answers your question.
Senator Keel.
Thank you.
Thank you, Senator Keel. Do members of the Finance Committee have further questions of Mr. Allen? Mr. Allen, thank you for that.
And that's over.
Presentation makes a lot.
Okay. It's going to be interesting to see how the legislature sells this to the public, because what Callan has identified and what they're going to identify to the people is that our 5% draw is too much. Okay. That's tacit approval, tacit acknowledgement or agreement that we've been drawing too much out of the fund. It's not sustainable going forward. Okay. We can't continue to draw 5% out and guarantee that we're going to have 5% to draw every year. Okay. So we got to drop it down to 4.5%. But the fear is that you won't have enough money in your earnings reserve account if you have down years and you lose all of your unrealized gains, and then the government won't have its money. Okay. So how are you going to sell that to the people? There are some Alaskans who are going to say, yeah, you're doggone right. You better take it out of the permanent fund. I don't care. Make it up in the future. It doesn't matter. Not going to hurt me. Don't tax me in order to make up the difference in spending. I mean, think about this. This problem gets worse over time. You got, if I go back to that slide and it says $170 million more one year and then $180 more the next year, and then it's $200 million and grows by, you get another $210 million the following year and $230 million the next year, right? So your money available for spending, not including oil taxes or federal dollars or anything, right? Just your permanent fund earnings is growing by that much every year. So your government likely gets bigger over time. More employees, more programs, whatever, right? Your spending continues to get bigger. And then when you hit that bubble, that burp in the economy where you can't draw, and if you had the discipline and you're like, oh, okay, then we're not going to draw from the corpus. We're going to only draw 2.5% because that's all we earned. Like the legislature magically finds discipline somehow, right? Okay, in that time frame, then what is the alternative? The alternative is you have to draw a tax from somewhere. You've got to draw it from savings, but you have exacerbated the problem because you've grown the size of government. So the amount that you have to draw from this economy that we have in taxes or draw from savings becomes that much larger because you've got this ballooned government that's growing at the size of the permanent fund. And if you're not disciplined of putting away savings money every year, which why would the legislature do that? I can't imagine they would. And your economy, your private economy, whether it's oil or non-oil, is not growing at the same pace as your permanent fund is, then you don't have the economy or the savings to be able to make up the difference with that larger government. It's just ballooning the size of government. So what happens then? The problem gets bigger in the future as your government grows on investment earnings, and then the house of cards basically falls down 1 year or 2 years. Or like I said, the national debt causes a national crisis, and you've got many years of austerity. Now you've got this huge government, and the pain of having to deal with all of that. This is not wise. This is not wise. The government should grow at the size of our economy. The government should not outgrow the people of Alaska's ability to pay for that government. If we allow this extraordinary growth in our permanent fund to fund our government, we're going to run into a problem in the future when we don't have that revenue based on investment earnings. Okay? People like to point at Norway and say, look, Norway's got this sovereign wealth fund and it's $1 trillion. They don't fund all their government from that. I think there's like a 3% draw from their fund. Okay? They should be able to get more than 3% earnings on their fund. Their government taxes people in order to pay for services. Okay. The health of the state of Alaska needs to rely on the health of our economy, not the health of our government. The people living here need to have good jobs. The government doesn't need people to have good jobs if it's 100% funded by its permanent fund earnings. The greedy people in Alaska, the people who are only thinking about themselves and their own wealth and avoiding taxes and not looking at a holistic and systemic problem that we have in the state of Alaska and the direction we're headed, because they're ignorant, not because they're stupid, because they're ignorant of this. Like, why would people spend the time that I've spent studying this problem, living this problem, working, trying to find a solution? Why would people do that? Most people don't. 99% of the people out there are not even concerned or thinking about this. Anyway, so it's going to be interesting to see what the what the sales pitch is for people. Likely make it too good to be true and people buy it, right? This is to protect the fund. We got to protect the fund by moving the earnings reserve account in so the legislature can't spend it, because the legislature is going to want to spend it. Yeah, you're right. The legislature is going to want to spend it, just like they are going to want to tax you, and just like they are going to want to grow. That's the nature of the legislature. Are they going to want you to have a better job next year? Crickets? None of this that we're talking about here, and none of the growth of the government off the permanent fund earnings has anything to do with you having a better job. Not unless you're working in investments or working for state government. Yeah. All right. What are you saying here, Brian? Likely government gets bigger. In what world has it ever shrunk or even remained static? Yeah. I mean, it doesn't. It doesn't. So this is where I diverge, my folks, my friends, this is where I diverge with the common Republican thinking, the conservatives that are choose my words carefully. Thinking about re-election, don't want to have the difficult conversation, aren't thinking long-term enough. This is where I diverge, because putting all of our eggs into this basket of the permanent fund, the way the legislature is setting this up, I can see the argument. Why did we have this briefing today by Callan? For one reason, to show that 4.5 needs to be 4.5 and not 5%. We'll have another briefing here sometime that's talking about why we need to roll the ERA into the corpus, right? It's just incremental arguments as to why we need to do what we want to do. Okay. I can see it lining up. And if you buy into it to say the alternative is we have to pay taxes. Okay. So we'll not be taxed, but your government is going to continue to grow. I'm going to reiterate this and be a broken record. That's the reality. Will your government grow if you're taxing yourself? Yeah, as your economy grows, or the legislature decides to tax you more. And that's the battle that every state has to fight. That's the healthy fight. We're not going to have to fight that in the future. If we continue down this path, the government's just going to grow, and you're going to wake up and you're going to have this large government, and you've got no way to constrain it. You got no way. You want to think you're going to win an election and constrain the size of your government once it's $200 billion fund and $10 billion or thereabouts coming out every year to spend? You think you can constrain that? I hope we're smarter than this. Brian, I know you weren't talking about me. Craig says Juneau should not be allowed to have representative senators considering they already control much of the administration. Oh, yeah. Well, I mean, you just know what their priorities are going to be, but they're still Alaskans. I mean, you're making an argument that Juneau should be treated like Washington, D.C., who doesn't get a voting member of Congress, right? Okay, I guess I can see it in that context. Carve out the Juneau borough and say you're autonomous. You don't get to have representation in Juneau or in the capital. I like where your head's at, if that's what you're saying. Hey, Brian, this was a very simple presentation, right? And he acknowledged that up front, said that this is going to be a simple presentation. And I think that the reason that it's simple is because they just needed to show a simple thing. 5% is too much. We need it to be 4.5. That's it. That's all the conversation needed. That you needed to spend an hour or 40 minutes or whatever the length of the briefing was here to say, yeah, we need 4.5%. We need to do that. That's all they needed. Now they've got what they need to justify passing the bill, and that's why they had it. Why they had the briefing. Okay, so again, this is why we'll have another briefing, I assume, talking about why the ERA needs to be rolled into the corpus. Anyway, okay, we're at, I've been doing this for an hour and a half. All right, we're going to be back tomorrow night, and we've got a couple requests here. Let's see. I'm going to make a note of this. Good. Craig, thanks for chiming in here. Another good topic is the LNG presentation today in House Resources. Let's try to take a look at that tomorrow. And see what they had to say. I have not seen it yet, and that would be a good thing to see. And what was the other one here? Okay. And Craig says S-corp tax vote in the Senate today was also interesting. If it passes the House, will Dunleavy veto? I suspect, considering the legislature gave very little consideration to the governor's fiscal plan, I doubt that he's going to think too hard about before vetoing their tax bill. Matter of fact, I could pretty much guarantee it. I expect the governor to veto it. But we can take a look at that in as well, if you would like. Anyway. Okay. Been good. I'm going to be with Michael Dukes in the morning. That should be fun. And I'm filling in for Bob Bird on Talk of the Kenai tomorrow from 3 to 5, KSRM, Radio 92 AM. I'll be filling in for him on Friday afternoon as well. So I'm going to go straight from radio to my podcast. Both tomorrow and Friday. And I'll also be filling in for Bob on Monday as well in the afternoons. So got a lot of talking to do. Gonna have to figure out what needs to be said. You want me to highlight anything on the podcasts? Don't be afraid to send me an email, producer@oversightlive.com, and we'll show it and talk about it. Anyhow, I wish you all the best tonight. I hope you have a good night, and we'll see you tomorrow.